Hello friends, a very warm welcome to my channel. In today's video, we are going to do the analysis of Faze Three Limited. It's a small cap company in the home textiles and technical textile sector. It's going to be a very interesting analysis as the management says that this company is at an inflection point of growth, and we are going to do an in-depth analysis as to understand their business as well as the financial analysis. If you are new to the channel, please do subscribe and hit the bell icon. And if you have not joined a Telegram channel, do join right now by searching my name on Telegram, because we share a lot of interesting analysis, news and views on our Telegram channel as well. Let's get started. So Faze Three Limited is in the manufacture and export of home textiles and technical textiles. Majority of the revenue of this company, close to 90% of the revenue, comes from exports. US and Europe are the major markets of this company, and close to 60% of their revenue comes from US. So out of the home textiles, their main product or their leadership is in the bath mats as well as the rugs. These two products constitute nearly 80% of the revenue for this company. And this company supplies to global brands like Walmart, Target and lot of other big retail chains. They have a vertically integrated business model, and they right from design, from yarn manufacturing till the finished product, everything is done in-house. And as of now, the company is operating at 100% capacity utilization levels. Now let's understand the history of this company in brief. They started in 1982 as a trading company called Faze 2, and in 1985 they started manufacturing. In 1990 itself, they got their company listed on the stock exchange, and in 1992 they went for capacity expansion. In 1996, they started their business of technical textiles, that is, they started supplying textile material to the auto sector like seat covers, etc. And this was in joint venture with a company called Onday. And in 1997, they started a new manufacturing unit at Silvassa. In 2003, they started another new manufacturing unit at Vapi. And in 2004, they acquired a company called Whitley Willows, which is a UK based company, to expand their business in Europe. In 2008, they acquired another company called Pana Textiles in Germany to further grow their business in Europe. In 2016, they became the largest auto textile manufacturing company in India. In 2019, if you remember earlier, they started a joint venture with Onday for technical textiles. They purchased their stake and they took over the entire business. And in 2020, they also started digital printing in the textiles. Now let's talk about the management of the company. Mr. Ajay Anand is the managing director, chairman and CEO of the company. He is the founder of the company and the promoter, and he is a graduate, and he has more than 3 decades of experience in the home textiles and the auto textiles business. There are other members of his family who are also a part of this business, managing this business in the form of board of directors. Now let's understand the business model of the company. To put it in a simple words, this company manufactures and exports home textiles and auto textiles. Interestingly, most of their manufacturing is order based, so there is no dead stock for this company. They have in-house team for design as well as prototyping for their customers, and they are vertically integrated, manufacturing right from the yarns till the finished products. Another advantage in today's times is the raw materials of the companies. If they are available within India itself, that is also acting as an advantage for the companies. And luckily for this company, close to 95% of the raw materials are domestically procured. They offer products as per their standards, as well as depending on the customer's requirement, they are able to take the designs and deliver the finished products. So this gives their customers flexibility to get the products designed and made by this company. And in terms of the minimum order quantities as well as the delivery time, also the company is very flexible as per their customers' needs. So this is a simple business model which this company operates. Now let's talk about their different business segments. The first segment we are going to talk about is the retail textile solutions. In this segment, they manufacture a complete range of home textiles products like bath mat, rugs, bedding products, pillows and cushions. Now one thing we should observe that in this, bed sheets are not mentioned, although bed sheets are a very common product in home textiles. So this company is not into manufacturing bed sheets. Their main products are the other products like bath mats, rugs and bedding products, which are pillow covers, etc. The next segment which they cater to is the hospitality industry. Under this industry, we cover places like hotels, resorts and other distributors which supply to these kind of businesses. So for this industry also, they manufacture cushion covers, bedding products, etc. Their main business comes from US and Europe, and now they are slowly entering other markets and gaining market share as well. The next segment which they have is the divergent textiles. Interestingly, in this they are manufacturing some innovative products other than the traditional textile business. To give you some examples, there is a product called Repoly which they have manufactured. The Repoly is a recycled polyester yarn. So this yarn is prepared from recycled polyester. Another additive which is a chemical which they have innovated is called Germi Shield. So what is GermiShield? GermiShield is an additive, which is a chemical which is used in the spinning process to impart antimicrobial properties to fibers and plastics. So when this additive is used on different fabrics, the fabrics become protective against different microbes and bacteria. So these are the different innovations this company is doing apart from manufacturing the traditional products. Another product which they have innovated is called the cosmeto textiles. Now this is made with a combination of two words, which is cosmetics as well as textiles. So they are giving properties of cosmetics to the textiles itself. So when somebody wears those clothes, their properties of cosmetics are slowly imbibed onto the skin of the person using it. So due to the effect of those cosmetics, the skin becomes smoother and better. So these kind of innovations this company is doing. Another innovative product which they manufactured is called protector yarn. So this yarn protects the fabric from different insects. So like these, there are different other products also which this company is manufacturing in the divergent textiles business. Now let's talk about the brands of this company. The company has a brand called AA Living. Under this brand, they do an offline business as well as an online business. They have a showroom, exclusive showroom in Mumbai. So under this brand, they sell premium bed and bath products, rugs and accessories. This is one of the most popular showroom under the premium category in Mumbai, and these products they supply to various global brands like DKNY, Marks and Spencers and Zara. Now another major segment which this company is into is the auto fabrics. This is the market leader in this segment, and they run this business through their subsidiary, which is also an individually listed company, is Faze Three Limited. So under this company, they supply auto fabrics to all the major OEMs across the globe. They work with brands like Ford, Hyundai, Suzuki, Kia, Toyota, Volkswagen, General Motors and several other OEMs. So to manufacture auto fabrics, they have 8 vertically integrated factories located near the different OEMs, and right from the design, prototyping till the delivery, they do entire thing for their OEM customers. Presently, the company has a capacity to manufacture 1 million meters of fabric per month. So this is one area where the company is focusing a lot on growing this segment. Now you can see these are the well-known brands across the globe which are working with them as their customers, like Walmart, DKNY, Target, Marshalls, Bed Bath and Beyond. So all the big global brands are working with Faze 3. So this shows the trust which the various companies have on this company. Region-wise revenue, if you see, US accounts for close to 60% of the revenue, Europe accounts for close to 30%, and the rest of the world's 10% of the revenue. Now let's talk about a few trends in the home textiles and technical textiles industry which we have been observing in the last few years. In the floor coverings like the bath mats, rugs, predominantly the supply or the manufacture was dominated by the Chinese up to 2019, because these are all polyester based products. But post 2019 there were few things which are changing in China, like the tariffs were changing, export tariffs were changing, the labor cost increased, the factories became more environment conscious, and because of all these things the Chinese manufacturing reduced. So the global brands did not want to depend totally on the Chinese manufacturers for their imports. So one of the best alternative left for them was to look for alternatives in India, and this is why we are seeing a lot of shift of demand due to China plus one strategy from the Chinese suppliers to the Indian supplier. So this kind of trends was observed earlier in 2008-9 in the bed sheets and the other cotton home textile products, and post that the Indian market grew a lot. So now the company, which is Faze 3's management, says that this kind of shift in the polyester based technical textiles is being seen from China to India now, and this segment will have the same kind of a growth which cotton fabric products had earlier a decade ago. The Chinese market demand is as close to 20 times which the India has. So even if 50% of the demand shifts from there to here in the next decade, then the Indian manufacturers will have huge amount of business shifting to India. So that is why they are saying that this company Faze 3 is at an inflection point of growth when it comes to the technical textiles business. Now how will any company be able to tap this business is to fulfill whatever the requirements are coming from various global brands. To fulfill their brands, the companies in India are doing brownfield and greenfield capex, and the same is being done by Faze 3 also. Now what is the moat or the competitive advantage which this company has over the other peers? They are a comprehensive supplier of handloom as well as the technical textile fabrics under one company itself. They work with global brands, and generally the brands rely on a supplier after thorough checking, and once that trust is established, the customer remains with them for a long period of time. So a customer stickiness is there in this sector. The company manufactures very niche products, and as we have observed that one of their segment, they are manufacturing very innovative textile products. They have in-house design capabilities and can design a product as per their customer needs, and they have faster turnaround times right from the design till the delivery. They can give the product to the customer within 90 to 120 days. In the home textiles business, they are working with world's top 50 retailers, and in the technical textiles or the auto fabrics business, they are working with all the most popular OEMs in the world. And in India, it is the largest automotive textiles manufacturing company. So these are the competitive strengths of this company when compared to its peers. Now, what are the growth triggers or the growth strategy of the company going forward? The company has a very healthy order book and it is operating at the peak utilization. They have also planned a capex of 80 crore, and interestingly, in this company, the asset turn is close to 8x to 10x. So with a very small amount of capex of 80 crore, they will be able to generate a revenue close to 800 to 1000 crores. Because of the China Plus One movement, it is expected that this industry and this company grows faster than what they have grown in the last decade. And whatever the new products the company is developing or entering into, those products are higher margin as well as higher ROCE businesses, as if the capital is allocated in the higher ROCE business, this is good for the entire company. Whatever global brands are working with this company, the company feels that those companies have an appetite to buy nearly 10x of whatever they are buying presently. So there is huge headroom for this company to grow even if they continue to work with the same brands. Now, what are the risks which this company might face in this business? Raw material prices, which is due to inflation, will have an impact on the margins of the company. The company derives close to 60% of the revenue from US. So if there is a slowdown in the US, that will have a major impact on the business of this company. Because of the supply disruptions, container shortages, the logistics costs have increased. And because this company is mainly deriving its revenue from exports, then the margins are again impacted. Although the company feels that there is a huge shift or demand from China to India, if it doesn't happen so and the Chinese continue to compete with this company closely, then the business of this company may not grow as fast as the management is expecting. There is concentration of revenue, as close to 80% of the revenue is derived from the top 10 customers. So if there is any discontinuance of business with any of these customers, the turnover of the company may be majorly impacted. The textile business is kind of cyclical. It's not evenly distributed or a continuously growing business. So that cyclicality is also to be kept in mind while we are investing in this company. After discussing the business analysis, now let's come to the financials part. Starting with the revenue, here I am comparing the revenue of the last 10 years instead of the last 5 years, just to show you that although the company has continuous growth in the last 5 years from FY 18 to 22, but the picture is not the same from FY 13 to 18. The company's revenue were increasing from FY 13 to 14, but from then onwards, from FY 14 to FY 18, the revenues were stagnant. There was no growth in the company in a time span of 5 years from 14 to FY 18. But from then onwards, the growth started increasing. What do we have to observe here is the growth is not even or not continuous in all the years in the last decade. There may be slowdowns which the company or the industry may go through, and that factor has to be kept in mind. If you are expecting that the trend of the last 5 years will continue in the coming 5 to 10 years, it may or may not be the case, and that's why you should closely watch the growth of the company if you are planning to invest in the company or this textile sector. But as the company expects, if there is a demand shift majorly from China to India, then the growth momentum which the company is experiencing in the last 5 years can continue in the coming 5 to 10 years as well, and the company may become a lot larger in terms of revenue as well as market cap. Now, when we look at EBITDA has grown from close to 19 crores to 80 crores in the last 5 years, which is a very good growth. EBITDA margins have improved from just 8% in FY 18 to close to 16% in FY 22, which is almost double in spite of the inflationary pressures which the industry is experiencing recently. The profit after tax was stagnant again in the last 3 years from FY 18 to 20, but in the last couple of years from 21 and 22, it has improved to close to 51 crores. Profit after tax margins have also improved from 7% to close to 10%. Similar to EBITDA margin. So in terms of margins as well as growth in the last 5 years, it's a thumbs up for this company. Now, when we look at the share capital, it is the same in the last 5 years. The reserves are steadily growing as the company is continuously making profits. The borrowings have slightly increased from about 74 crores in FY 18 to about 167 crores in FY 22. But still the debt is under control, as the debt equity ratio is just 0.59. The trade payables have gone up to about 20 crores, but still they are much under control. The fixed assets are steadily growing as the company is doing capex whenever it is required, and as of now they have close to about 160 crores of fixed assets on the balance sheet. The inventory levels have slightly gone up to about 110 crores, but these are in line with the revenue growth of the company, so there's no problem. The inventory days are slightly higher. They have reduced from earlier 220 days to 180 days, but still 180 days are slightly on the higher side. Maybe because it's an export oriented company, it could be a little higher. But still, if the company is able to work more efficiently and bring down the inventory days lower, then the working capital management may be more efficient and less of capital may be required to run the daily affairs of the company. The trade receivables have slightly gone up to about 87 crores in FY22, but these are also in line with the increase in revenue from the company. The debtor days are more or less the same. They are just about nearly 2 months. The cash equivalents have improved from 2 crores in FY18 to close to 56 crores in FY22, and the operating cash flows are sometimes negative. So this is again one thing which you have to closely monitor, that their operating cash flows are going negative even though the company is making profit. Similarly, the free cash flows are also becoming negative. Working capital management front as well as the cash flow front, you have to closely monitor the company in case you choose to invest in them. The ROCE is improving along with the margins. The ROCE has gone up from 11% to 20%, which is again a very good sign. So margin improvement and return ratios improvement is a thumbs up. The revenue growth and the profitability growth is a thumbs up, but the areas of concern are the working capital management as well as the cash flow management for the company. Now let us look at the shareholding pattern. There are no institutional investors in this company. The promoters hold close to 51% and the public holds close to 49% in the company. An interesting thing to note is the marquee investor, Mr. Ashish Kacholia, holds about 4.66% stake in the company, which again gives us a sign of confidence in the company. There is no pledge. The statutory auditors of the company are MSKE and Associates. Executive directors get a remuneration close to 1 crore. So one related party transaction has caught my eye in this company is there's a purchase of property, plant and equipment worth of 4.2 crore from a related party private company called ARR Bath and Home Private Limited. So if you choose to invest in the company, you can write a mail to the investor relations and ask them more about these transactions and get clarity before investing. The ROE is close to 20%, which is good, and although it is less, but still it's a dividend paying company with a dividend yield of 0.15%. Now let's talk about the valuation and the competitors of the company. In the listed space, we have close competitors which are Welspun India, Trident and Indocount Industries, although it cannot be a like to like or apple to apple comparison. In terms of revenue, Faze 3 does a revenue of about 500 crores, Welspun India close to 9,300 crores, Trident close to 7,000 crores and Indocount Industries close to about 3,000 crores. So these companies are much bigger than Faze 3, but since they are into similar business, we are just comparing with them. In terms of EBITDA, Faze 3 does about 16%, ROCE 20%. In terms of PE, it is trading at 15 and market cap to sales of 1.6x. Welspun India does an EBITDA of 15% and ROCE of 15%, which is a little similar to Faze 3 and trade at a PE of 12 and market cap to sales of 0.8x. So it is trading at a cheaper valuation than Faze 3. Coming to Trident, Trident has EBITDA margins of 22% and ROCE of 23%, which is much better than Faze 3, and hence it is trading at a higher valuation of PE 27 and market cap to sales of 3.3x. Indocount Industries on the other hand has EBITDA close to 19% and ROCE close to 22%, which is better again than Faze 3, and it is trading at a cheaper valuation, which is 8 times the earnings and 0.94 times the market cap to sales. Now when we talk about Faze 3 specifically, it's a face value 10 share, and in terms of price to book value it is 2.8x, and the median PE for the last 5 years is 6.5 times. So comparing with the peers and comparing with the median valuation the company has been getting in its history in the last 5 years, the valuations appear to be expensive, and these valuations can only be justified if the growth which the company has shown in the last 5 years continues in the next 5 years or so. If there is again a cyclicality and there is a slowdown in the business of the company, there is a risk of de-rating in the valuations and the stock price may fall. But if the company is able to maintain the momentum of growth, then the valuations become justified. Now let's look at the chart. The chart is also not a continuously rising chart. From 2017 to 2020, close to 3 years, the stock has been in a downtrend consolidating. So similar to the performance of the company in terms of revenue, the chart also shows consolidation or a downtrend for the last 3 to 4 years up to the COVID crash. Post-COVID, the stock went up continuously and it even crossed the earlier high, which was 150 made in 2017 in July 2021. There also it went up and made a high of close to 400, and thereafter it started consolidating. So the chart appears to be stretched, and buying at the current levels without any stop loss could be risky. So if you have the conviction on the growth of the company with the same momentum, you can enter the stock gradually at the current levels but with a stop loss. But if you are still doubtful of the momentum, then you should wait for the stock to correct and consolidate, and when you get more comfort on the valuations, then gradually you can start building the position. If you want the valuation comfort and if you want to be on the safer side, 150 to 200 levels could be a range where you can start accumulating the stock of this company. So this is about Faze Three Limited. To summarize, let's discuss the thesis and antithesis points for our investment or our analysis. The company has market leadership in the auto textiles business. The management says that the company is experiencing an inflection point of growth at this stage, which is a strong pointer to invest in the company. They have global partnership with the top 50 retailers across the globe and the top OEMs in the automobile sector. The margins of the companies are improving and the return ratios are also improving, which is showing improvement in the performance of the company. When it comes to the antithesis points, you have to keep in mind that this industry could be a little cyclical in nature. The growth of the company has not been even, it is inconsistent. There was stagnancy in growth in the few years, and then in the last 5 years we have seen growth. So we have to closely watch whether the growth momentum continues or not. In terms of competition with China, we cannot be very sure that the market share of China will shift to India. If the Chinese competition continues to exist, then the growth of the company may be hampered. In terms of cash flows as well as working capital management, we have to keep a close watch on these aspects when you are investing in the company. So this is about Faze 3. I hope you like the analysis, the positive and the negative points we have discussed, and I'm sure at the end of the video you will be able to take the right decision of investing in the company. If you like the video, hit the like and subscribe button and hit the bell icon to activate the notifications. If you want me to make videos on your favorite shares, do mention the company's name in the comments below. Thank you for watching and have a wonderful day.